Hey everyone, thanks for tuning in to our July 2024 Market and Strategy Update. We hope you've enjoyed a wonderful summer and been able to get a little reprieve from the heat recently. I'm Chad Smith, a managing partner at Reveille Wealth Management and part of our investment committee, along with the group that you see here. So today Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Your investments are often the most important tool for helping you achieve your financial goals, but they are a means to an end. So as a reminder, all that we discuss should be viewed within the context of your financial plan and as part of our passion to help you achieve your goals and mitigate risk. Our objective today is to bring clarity to how we are attempting to actively manage risk within our investment strategies and how that relates to what you may see in your portfolios. So during July, equity markets advanced broadly, with equal-weighted indices, small caps, mid caps, and value-oriented stocks taking a leadership role. Likewise, bonds generally improved and continued to trend higher. The longer-term uptrend that commenced in the fall of 2023 remains intact, and during July exhibited a more constructive tone as market breadth broadened out and improved. However, even with broadening market strength during July, some near-term volatility is to be expected, driven by seasonality and anxiety surrounding the election. We emphasize the importance of process over prediction, relying upon our rules-based investment discipline to help navigate the market landscape. As we have been highlighting in a series of recent videos and white papers, the extremes that have been developing in market leadership concentration, along with the relative outperformance and relative valuation of large cap U.S. stocks versus many other global equity asset classes, has grown to historical levels. We have been sounding the alarm that this characteristic posed a potential risk to investors should a change in market leadership occur, and is a reason why we have been highlighting more attractive opportunities in mid-cap, small-cap, and foreign equities going forward. Well, this thesis has seemingly been starting to unfold during July. Recent inflation and economic data has pointed to a continuation of moderating inflationary pressure and even developing economic weakness potentially on the horizon. This data has substantiated the idea that the Fed may be led to start lowering the Fed funds rate sooner than what has been expected by the market. Now, the prospect for falling interest rates, combined with current prevailing yields and price discounts that exist across many types of bonds, continue to lead us to be very constructive on the bond market. Through the end of July, we remain fully invested across each of our strategies, with the exception of commodities, which did recently turn back off within our discipline. So I'm now going to turn it over to Stephen to take us through some of the recent market trends.
All right, thanks, Chad. So this month we're going to switch it up a little bit. So we're going to welcome in a larger audience. So we're going to cover our broad market topics first, followed by a review of the holdings in our model strategies that are going to be available for our clients only. So I'm going to encourage everyone, if you need a refresher on our rules-based investment discipline, please go to our website, reveillewealth.com/RBID, or contact us directly for a review, and we'll go over our process with you. Also, we are posting frequently market-related commentary to our social media platforms. So please find us on Facebook, LinkedIn, and YouTube. Like and subscribe there, so you can be notified of any new commentary that we're putting out. All right, here we go. So in last month's video, I shared several reasons why the S&P 500 index has become an unreliable index, an unreliable barometer for the health and direction of the U.S. stock market. So last month, I said this. But where the breadth numbers deteriorated here in June from where they were at the end of May, indicating some shorter-term weakness in the market, we did not see that in the headline S&P 500 index. And uh, we're going to see in a minute why that weakness was masked and why it is a real risk for the S&P 500 going forward. Well, wouldn't you know that July was almost the mirror opposite of what we saw in June. In July, we saw a very strong recovery in market breadth. Notice the percentage of stocks trading above their 50-day and 200-day moving average, and how much it increased from the end of June to the end of July. And recall the reason that we look at this data to begin with. That if a stock or an index, if it's above its 50-day moving average, it's probably in a short-term uptrend. If it's above its 200-day moving average, it's probably in a longer-term uptrend. And so we've been fully invested in stocks really since late last year, per our rules-based investment discipline. So we want to see the market go higher. But the market can't sustainably advance unless we see the majority of stocks in the index move higher. So thus we analyze these market internals to help us gauge the underlying health of the market. But here again is the disconnect. So in June, the headline S&P 500 index, it went up despite the fact that the internals during the month, that breadth deteriorated from May to June, right? Didn't make sense. And I said as much in last month's video. But in July, we saw some of the best market action that we've seen in a long time. A large surge in breadth, essentially across every time frame. 50-day, 100-day, 200-day, etc. But you wouldn't really know that if you looked at the S&P 500 or the NASDAQ. They were essentially flat to down on the month. So how can that be? Well, the S&P 500, it's supposed to be a reasonable benchmark to demonstrate how the average stock, at least for large companies in the United States, is behaving. The reality is, and I've written as much in the 2 white papers that we've published over the last 6 weeks or so, is that the S&P, it's really been hijacked by a small number of very large technology stocks that currently trade at very lofty valuations. In fact, the correlation between the S&P 500 and the median stock in the index has fallen to a record low. This means that this widely viewed index is currently a very poor indicator of what's actually happening within the index. And given the parallels that it has to prior periods, it suggests that this is potentially the epicenter of market risk. So, but take heart, not all is lost. So as I outlined in my recent white papers, there are opportunities in this market, but it's likely found in areas that investors have shunned or abandoned because, well, they probably haven't done all that well recently, particularly on a relative basis compared to the S&P 500. So this chart comes from our friend Ryan Dietrich at the Carson Group, where he examines a 40-year history of small cap stocks versus large cap stocks. And we've been preaching this story of diversification into small caps for a while now, as small caps have been relatively cheap versus their large cap counterparts. But that hasn't translated into outperformance yet. And there's a season for everything. There's a season for small caps to outperform, and that period of time is drawing near. So said another way, there's going to be a season for the diversified portfolio where investing in areas other than large cap U.S. stocks is going to bear some visible fruit. Well, small cap stocks today, they're as cheap as they've been in the last 40 years. And ironically, the last time they were this cheap was in the throes of the S&L crisis in the late 80s and early 90s. All right, sound familiar? Because last year we had this little mini financial crisis where Silicon Valley Bank, Signature Bank, and maybe one other went under. Good times, right? Well, nothing to see here. You know, S&P 500 and NASDAQ, all is well. Well, they say history may not repeat, but it often rhymes. Well, here we are. We're back at these same levels that this ratio troughed out at about 34 years ago. So one thing I find interesting here is that the last time that we reached this level, where small caps were at this 2 standard deviations of cheapness versus their average over time compared to large cap stocks, that it only took about 4 years, but within 4 years or so, they had not only erased that weakness and underperformance, but they rebounded so strongly that they became historically expensive. So the question now is history going to rhyme again? And are we going to see a very strong rebound back in the small cap stocks? We're going to find out in due time. Let's move on and let's talk about some macroeconomic stuff for a minute and what it means for the Federal Reserve. So the Federal Reserve, as many of you know, has a dual mandate from Congress: full employment and price stability. That's inflation. And both of those, but namely inflation, got away from the Fed a couple years ago. So remember, the Fed is historically late to the game in changing policy because they're using data from prior periods to make decisions about where they should be setting monetary policy going forward. They didn't even begin raising interest rates from 0 until March of 2022, and even then they were raising slowly at first because they believed that this inflationary pressure that was popping up was transitory. Well, we know that inflation went to 9%, at least the number that they reported to us was 9%, and they have made some progress on that front. We're not running at that 9% annualized number anymore. Now it's more like 3%, maybe a little less, but it's still a little higher than the Fed would like to see it. But the problem is now that the labor market is showing some real signs of weakness. So full-time employment peaked in November of 2023, and it's been in negative territory on a year-over-year basis for 5 consecutive months now, right? And in the last 50 years, every time the yearly growth in full-time unemployment has dipped below 0, it's been in a recession, right? These gray areas here represent recession. So every prior time when we've dipped below there, it's happened in a recession. So viewed through this lens, the Fed's already late, haven't reduced rates yet. And so, oftentimes the Fed tries not to make any changes to monetary policy during election years because they want to appear to be apolitical. But they've got a real conundrum on their hands right now. And the labor market is something that cannot be hidden from the public view. People are living in it, right? And so where the markets had been anticipating that the Fed might cut rates once after the presidential election this year, now the expectation is that the Fed is going to cut in September with at least one additional cut after the election. There have been some rumbles that, given some of the volatility that we've seen here in early August, that there might be an emergency Fed meeting to cut rates because they failed to cut in July. Right? So the implication here cannot be understated. From a labor market perspective, which is one of the 2 mandates that the Fed has, this is a recessionary indicator, full stop. And as we see the economy slow down, which this only happens in periods where the economy is slowing down, that should translate to lower interest rates, which should be a positive backdrop for high-quality bonds, but it creates a much riskier backdrop for stocks, especially areas with lofty valuations like the NASDAQ and like the S&P 500. So let's move on. We're going to talk about U.S. stocks here just in a general sense. So we're going to look at the S&P 500 index. Remains in an uptrend, right? Again, the index had that pullback within this ongoing uptrend in July, despite the fact, and we're going to see when we look at some other areas, that Most stocks were actually higher in the month of July, and in some cases materially higher, but not the S&P 500, but still in an uptrend here. Okay, mid-cap stocks, this is where we start to see some of that breadth improvement, right, that we had a pullback in June, retested this uptrend line, and then had a very strong bounce in the month of July. Small cap stocks, similar pattern here, had pulled back, retested that uptrend line in June, which corresponded to prior highs from 2023, that former resistance turned into support, bounced off of that level, and had a very strong July. So in the month of July, the Russell 2000 index was up 10% compared to the S&P 500 that was effectively flat. The NASDAQ was down over 2% for the month. So very large level of outperformance from small caps in July. And that outperformance, we would say, is coming from a logical level. That if we were going to see small caps outperform, this is where it would start to outperform. We are back at the lowest levels that we have for this data set, all the way back to the peak of the dot-com bubble in March of 2000, of the Russell 2000 versus the S&P 500 index, or small cap versus large. Back where that level would have troughed out at in 2000, we have retraced the entire thing. So if small caps are going to get going and they're going to outperform, this is a logical level for that to happen. In that significant level of outperformance that we saw here in July, coming at a place where we would expect to see something like that happen. So, all right, foreign stocks, we're going to start with the developed international stocks. So still in an uptrend here, just kind of stair-stepping their way higher. So still want to be invested in the international stock market. Emerging markets, similar picture. They've been in an uptrend here since the fourth quarter of last year. They've gotten back above, kind of similar to the small cap stocks that we looked at here just a little bit ago in the Russell 2000. They've gotten back above these prior highs from 2013. I think that's significant. We want to see it remain above that level, but still just kind of stair-stepping our way higher here in emerging markets. We're going to look at bonds here. So the uptrend that started in the fourth quarter of last year for bonds, still in place. Importantly, we are getting back above those prior levels of resistance. That's very constructive. And we've been positive on bonds since late last year. They're offering some of the highest yields that we've seen in the last 10 or 15 years. And a number of the areas within the bond market are still trading at some pretty good discounts to their face value. And as the Fed starts to cut rates, that's likely in an environment where high-quality bonds are going to do well. Lastly, we're going to look at some real assets here. We're going to look at commodities and real estate. So commodities were unable to hold their uptrend, and they've now turned off. They've entered a new downtrend. Given the amount of exposure to energy within the commodity index, right? So to oil and gasoline, etc., it makes you wonder if this new downtrend here is potentially a reflection of a slowdown in overall economic activity. Only time's going to tell, and we don't need to spend any time focusing on so much of the why as much as we simply need to acknowledge the shift in the direction of the primary trend and respond accordingly. Lastly, we're going to wrap up with real estate investment trusts, which have been churning sideways, for a number of months now, really since the beginning of the year. But last month had a great month, new 52-week highs here for real estate investment trusts. So this asset class, it's really struggled in tandem with the bond market over the last few years, but the prospect of lower interest rates has really given it a boost. All right, that's it for our market review. I'm going to hand it to Chad quickly for a recap, and then I'll leave us with some final thoughts. Chad?
Thanks, Stephen, for the updates. So, stock and bond markets performed well during July, with strength in the equity market most prominent in areas that had previously lagged, such as small and mid caps. Signs of a rotation in market leadership, which we have been anticipating, were evident in July, as weakness in large cap technology stocks appeared while relative strength was exhibited from equal weighted indices, small cap and mid cap stocks, and dividend paying stocks. Even with the broadening market strength during July, some near-term volatility is to be expected based on seasonality and anxiety surrounding the election. Recent economic data suggests that inflationary pressures continue to moderate along with signs of economic slowing, which is prompting the Fed to change its tone with regard to monetary policy. In particular, the prospect for the Fed to commence lowering interest rates sooner than the market had previously assumed is bringing down interest rates along the yield curve. The falling interest rates could be constructive for certain areas of the equity market, but should be particularly supportive of bonds, which we continue to favor. So far this year, our bond positions are holding up well and still offer an attractive combination of yields above money market rates and still discounted prices, creating an attractive opportunity as we look forward. With the exception of commodities, which turned off late in July, we remain fully invested across each of our strategies. And as always, we will approach the market environment with our focus on process over prediction, utilizing our rules-based investment discipline, or RBID, to strike a balance between managing risk and reward. So I'm going to now turn it over to Stephen for some final thoughts.
Thanks, Chad. And thanks, everybody, for tuning in here for the July review. We hope that you found it insightful. If you have any questions and want to learn more about our rules-based investment discipline and how our process is helping us make decisions of how and where to allocate capital, please reach out to us. You can email us info@reveillewealth.com. Hope you have a great rest of the summer, and we will see you next month. Take care.